Hello and welcome to the Small Business Briefing. I'm Brian Calley, CEO of the Small Business Association of Michigan.
Hi, everyone. Welcome. Thanks for joining us today. I'm Sarah Miller, Vice President of Operations. I'd like to start off by welcoming one of our new members. They are a premium member. It's Five Forks. They specialize in baked goods and they're owned by sisters Madison and Mallory. So thank you for joining and welcome to SBAM. All right, let's get started with today's show, starting with unemployment. So unemployment is holding steady in Michigan. Brian, what did you see in the numbers that were kind of under the hood?
I always have a kind of a love-hate relationship with the unemployment number, but I like to cover it because it's what's always in the news. But it can move in ways. Sometimes it goes up for good reasons, it can go down for bad reasons. Although the thing I've been most concerned about in Michigan over the last year and a half has been the way it's steadily been creeping up. No one month where it like jumped up a lot. And yet if you look at it over time, a definite upward trend. However, it didn't move. It's actually been the last few months just really kind of hanging around the same level at 5.3%. So that is that's good when in the context of the kind of previous rising environment. The 5.3%. The In gross numbers, you see the number of a couple of moves in terms of like total employment fell by 5,000, but then the overall number of people in the game, people in the workforce, it dropped by the same amount, and so that the rate stayed the same. So this would be one of these cases where it didn't go up. Um, it stayed level, but it stayed level for not the best reason. Um, but this is kind of par for the course for the economic picture right now. Lots of mixed results, lots of uncertainty out there. But in this case, you could definitely see we're at risk for the rate kind of slipping up a little more, but holding actually in a pattern now of holding steady.
So, Brian, how does Michigan stack up with the rest of the nation?
We're still high compared to the nation. The nation on average is at 4.2%. So it does put Michigan in over the last several, actually, I think much of this year, we've been top three highest unemployment, definitely top five, some cases number two to Nevada at number one. So, in this case, though the US rate at 4.2 actually did tick up a little bit, went from 4.1 to 4.2%. Again, not a huge move. Things do seem kind of, they're in a holding pattern in a lot of ways these days. And so our position vis-a-vis the federal picture about the same.
All right, and so what is the latest for labor force participation?
Yeah, labor force participation, you remember after the pandemic, like it seemed like all we talked about was labor force participation because the rate got quite low into the mid 50s, the number of people in the workforce. It did go down a bit, 61.6%. So it's on the lower side of normal when you take the pandemic picture out of it. But still within a kind of a normal range for Michigan, which is to say our labor force participation has tended to be lower than the nation, at least since the year 2000. Labor force total of 5,077,000 people. That, the last couple months, you've heard me say, just like I said at the beginning of this, that the labor force, like the unemployment rate has been holding steady, but number of jobs actually went down and the number of people in the labor force went down. So the unemployment rate stays the same. Um, Michigan's labor force total of 5,077,000 actually is the lowest point since August of 2024. And at that point, the state was kind of in an upward trajectory, still in the kind of recovery mode from how low it got during the pandemic. So Not great, but again, not a cliff either, just erosion, I think would be the best way of putting it.
All right, let's talk about some other economic markers. Last week, there were some record highs in the stock market, but economic data is still somewhat cloudy. So, Brian, where are these record highs coming from?
Yeah, I've actually been a little surprised at the resiliency of that investors have at the moment. I think one clear thing that happened was the interest rate picture that I described before, which by the way is also still in flux. The interest rate picture becoming more clear, or so investors thought before, was something they were pretty excited about. So it was almost like weaker economic data made it more likely that the Fed would finally relent and let interest rates come down a bit. So I think that created a certain resiliency, like an expectation that has persisted through shaky or even in some cases bad news. The there is a there's also a sense that you got this macro level data, but corporate earnings have actually been holding strong. In many cases, are beating the street's expectations. And so what this happens, they price in things previously lower, expectations lower, and then expectations are beat. And so it drives somewhat of a rallying effect. The other thing that I think it's sometimes, like when we look at a political issue, like there's big debate, like a tax bill that goes through Washington, and then it passes and it's done, and then we move on. But really, I think investors are still understanding and starting to price in some of the benefits, the investment benefits that are in that bill. And so the relative cost of making expansion investments is is going to be lower for a few years because of some of the things like bonus depreciation that is included. So it's difficult to put your finger on one thing other than the expectation of interest rate cuts. I think that's clearly something that is driving investor confidence. But these other factors they take a little longer, I think, to be fully priced in. So the other thing that if you're to look back on previous like Wall Street and stock market performance compared to a slower economy or shaky economic data, um, there's in some ways people I think have become a little bit immune to predictions of recession because there are way more predictions of recessions than there are actual recessions. So what we see, like sometimes even there's, a lot of economists will go to a place where there's a lot more pessimism about the future, but that's not necessarily indicative of an actual recession. And so I think investors are also kind of hardened to predictions, and until they actually see negative GDP coming through, they're just going to keep on plowing through. All of those factors, I think, play a role, but I think the way that the jobs report and the most recent CPI report both pointed to the Federal Reserve lowering interest rates is the main factor that is just kind of plowing through all other expectations.
All right, so we're talking about interest rate cuts. You say they are most likely coming, but there's some other data that might give you a little pause. Can you share a little bit about that?
Yeah, so a weak jobs report, revision of previous months, plus the consumer price index, which was I didn't, I meant to pull the slides and I was going to share them. We'll look at them next week. At 2.7%. That actually CPI came in lower than expected, even though the core inflation, when you take out food and fuel, was actually a little higher than expected. But you consider all these factors, inflation, top line inflation lower than expected, weaker jobs report. There's no way that the Federal Reserve can resist increasing or lowering interest rates after kind of a record period of them being high when compared to how low inflation has been, especially the period under 3%. But since then, the producer price index came out, and that ended up being higher than expected. The producer price index, the PPI, is different than the CPI. So CPI is for consumers. Producers, it's the cost of doing business. That came in higher than expected. And so the part that was kind of impressively high, if you will, was just the literal month over month. So 0.9%. So 0.9% just on 1 month, last month's survey over this month's survey. That's annualized that. You see, that's a big number. I think kind of surprised people. And then that also, when you can consider it, compared to the last 3 years, it was the sharpest increase in about 3 years. So and you compare it, the annual rate, the PPI annual rate, so 0.9 month over month, the year over year is 3.3% when the expectation was 2.7. So this is it's different. You don't know how much of that will be pushed on to consumers and how much will later on be incorporated into or absorbed into the CPI, and how much will just be eaten by the producers, if you will. That's an open question. And so this is the first, since those other kind of seem to be irrefutable pointing toward lowering interest rates. If the Federal Reserve was just determined not to take action at this point, they could look at the PPI as the first kind of solid information to say, well, maybe we should hold steady. They're definitely not going to increase interest rates, but it's the first thing that I've seen in the last couple of weeks that made me think, well, I mean, if they really wanted to keep them, they could point to that as an excuse why. But I looked at the prediction markets, and boy, I tell you that Wall Street is still very, very confident that rate cuts are in our future. I will be very, very surprised if it's more than 0.25%. Scott Bessent, I read an article that he had said, well, the rates are 1.5%, 1.5% too high right now. There's never been they don't cut that. I mean, they cut 1%, 0.25%, 1/4, or 2/4 or 0.5% is the most you're going to see it move. But difficult for me to imagine any scenario where they go down by more than 1/4 in a single meeting. So at least given everything that we've seen. So that's what I'm expecting at this point. Is not any different than before, but I thought maybe I should just throw in that there actually is a piece of data that would suggest otherwise. Let me just cover one other thing in looking at the year over year, the categories for the CPI. Again, I'll share the slides next week, but looking at the big movers, the reason why you saw the headline inflation was lower than expected, but the core inflation was higher than expected. I think you could really point to two items that kind of pulled those in different directions, if you will. Gasoline and fuel oil. Gasoline 9.5% below this time last year. Fuel oil 2.9% below last year. Those fuel is just commodities. So when they look at core inflation, it doesn't include that. That's why you saw one measure lower than expected and the other measure higher than expected. Looking at what has gone up the most, natural gas actually up 13.8%. And then also motor vehicle maintenance and repair was up as well. It's always interesting to me when I see these things, how interconnected everything is. And so if you have a period where people are kind of waiting and seeing on, either there was a bunch of new cars that were bought earlier than people were planning to try to beat tariffs, or people now not replacing cars but fixing their older cars because of cost considerations, then things like repairs of vehicles, there's higher demand on that, which would push the price up. The way these things are connected are pretty incredible. One of the top five, actually, I guess it's sixth on the list that I have here, motor vehicle insurance as well, which we've actually been hearing quite a bit about. So there's all the data on inflation in terms of the categories. You can definitely see how it fits together, and stuff is moving about like you would expect it to move, given all that we know about policy changes, and things relative to others. It looks as about as you would expect.
All right, well, thanks for that update, Brian. I do want to mention a couple of upcoming events before we say goodbye today. You know, we love engaging with you here on the briefing, but it's always fun to see you in person too. This Thursday, if you're in the capital region, we'll actually be at the Pickleball Barn in DeWitt. It's supposed to be a lot of fun. So if you want to come to one of our owner-to-owner events here in the Lansing area, this one will feature pickleball on Thursday. And then on September 4th, we're hosting our annual golf outing. It'll actually be at College Fields, which is in Okemos. So if you are a golfer and you'd like to support the SBAM Foundation and just have a fun day out networking with other small business owners, we'd love to have you there. Our website's undergoing a little bit of maintenance for the next couple of days. So if you're interested in attending, go ahead and email us at events@sbam.org and we'll take care of that for you. But we do hope to see you at one of these upcoming events.
Yeah, and Sarah, can I go ahead and mention too the gubernatorial series as well? So coming up on September 11th will be the first one. We have extended invitations to 8 different gubernatorial candidates. And in this, what this is kind of a more of an intimate one-on-one chat. So just me and that gubernatorial candidate having a discussion and then taking questions from our members. And the first one, September 11th, will be with Mayor Mike Duggan. It will be in Grand Rapids. So he's an independent candidate for governor, and has been out there working really hard on the campaign trail. And we want all of our members to have an opportunity to engage with the people that aspire to be the next governor. So we put out 8 invitations. We got 8 acceptances. So I'm very confident that those that are, in a position to have a real shot at becoming the next governor, whichever one comes out on top is going to be a part of this series. So please do, if you're interested in that, you can email the same email address that Sarah just talked about. Otherwise, the next day or two, we're doing a conversion on the system that we use. You'll be able to go online and register as well. But on the gubernatorial series, seating is limited, so don't wait until the last minute.
Yes, I'm glad you mentioned that, Brian. And just one more note on that, this event is complimentary to our elite and VIP members. Other members will be ticketed at $60. But yes, events@sbam.org or visit the website on Wednesday to register yourself. We hope you have a great week and we will be back here next Monday at 3 o'clock.
Thanks, everybody. See you next time.